So in this video, I'm going to tell you why I am betting against Tesla. I think they're going to go lower. I just bought some puts. I'll talk about that as well as teach you how I am able to collect premium by writing cash secure puts against the contracts that I bought. So here's just a quick technical analysis on Tesla. I'm not going to talk about their earnings and their profitability. You can go on and find a bunch of different videos like that. Frankly, the short story is I still think they are very, very overvalued, trading at like a 70 PE. I know they're not a car company, but they make all their money selling cars. Like I said, I can repeat that same video that you're going to see everywhere, but I am a technical trader. I like to use certain levels. And when I am trading LEAPS, which I haven't bought a LEAPS in a really long time. I like to look at the daily chart, look at certain levels, and then make my decisions from there. And this, to me, seems like a no-brainer for a couple different reasons. So one major thing with Tesla, guys, and we can see going back from January 2022, it really has failed to make all-time highs. We got January, April, September. It danced around it for a little bit. Now, there is this white area here that I will talk about, but most recently, guys, July 2023 was the last time it really pushed to go above those September highs, and it just couldn't do so. And it's just been in this nice range, this nice channel downward. I think it has a long way to go, but how I chose the puts that I bought is based around this little white square. And maybe the only apprehension I have, because Tesla seems to be a company that has a huge following, and I feel like it kind of trades along that following, but it's still, since January 2022, it's been on a slide. I really think it's going to go lower, and I didn't buy puts for how low I thought it was going to go. Here's exactly why I chose the strike price that I did. As we can see here, we got all the way down here to 105. All right, that was really, really low, and that was when I was posting on here about how low is it going to go, and it kept going lower and lower. Okay, it then came up right around that 220 zone, and this was like, okay, are we going to recover? Maybe this will be the time that we are going to come back up in to 2022. We did not go down that way and pretty much got up to 220, and then we started to work our way back down. Now, April 2023 is a really, really big level for me. We can see I wrote here, it failed to make new lows, which would indicate maybe a little bit of a reversal. Okay, this was an area that we can kind of watch. And this 151 goes all the way back to October 2021, where we can see over here there was a bunch of consolidation right around that 150 before it started to shoot all the way up and reach highs almost around 300. So what I'm thinking to myself now, especially with the earnings, and we can see this gap, and we'll zoom in here in a second and see a little bit closer, but really I chose a strike price on the puts that I bought right at 150. I don't see any indication from a technical analysis, and like I said, I'm no professional, but from what I see, I don't see a reason. Once we broke this consolidation here in between 200 and 220 and kind of just blasted through it, and then we took this low at 200 and we've been holding below 200, I don't see any reason why Tesla is not going to go down and test this support that we had back in April, and also see if it can act as support again after this October consolidation way back in 2021. So that's why I chose the strike price. Now, guys, there's often this misconception that to profit on puts that you buy, it has to actually go down to 150. It does not need to go down to 150. All I need is it to go down in that direction, or implied volatility to really, really change. There's many different ways that the options premium, the value of the contract, can go up over time. So that's how I chose the strike price of 150 for the puts that I bought. Side note, so you can come back here in a year and call me a donkey, I think we're actually going to go down and test that 105. But what's probably or hopefully going to happen is it'll come down in that 160 zone. My puts will be very, very profitable. I will sell to close them because I have no intention of exercising these or owning the shares. Guys, all I care about is the value of the contract going up. When you are buying options, you don't care about the shares. You don't really care about the share price because options contracts change in many different ways. What we care about is the value of that option going up so I can sell it back for a higher price than I bought it for. I think what's going to happen is I will get rid of these around 170 when it gets down around that zone, maybe 165, 170, and then I will watch this 150. If we break through this 150, boom, then I can write more puts for 105. Or if we get that nice rejection like we did in April, then I will target calls up around the 200 zone. Going in about $50 increments here with Tesla right now. Let's zoom in and see exactly where I entered these puts, and then I'll show you the contracts as well as the spread that I created. Now for my shorter time frame stuff when I'm day trading, guys, I'm a big supply and demand trader. There's many different ways to draw supply and demand, and the zone that I have here in white, there's really no like fixed top, bottom. It's kind of just a zone. It's a place to draw my attention. And we can see kind of we had a little bit of a bounce, struggled to get through, shot through, kind of came back and retested it, came back up, and then once again came down into it, tried to pull off, came back down into it, tried to pull off. And then when we went through again and flushed down below these wicks here, down below these wicks here with the earnings, I was like, all right, I think there's a chance that this is the time that we are going to go lower. And I entered the trade on February 2nd, about 10 o'clock in the morning. I think it was 9:50 or so on this exit right out of here. And I bought the puts. Like I said, I didn't care, guys, so much. This is a 30-minute time frame, so each one of these candles is 30 minutes. I didn't necessarily care what it was doing that day. I opened this option for what you'll see for over a year away. But really what I was doing watching that day was to make sure that we didn't get an immediate bounce, because guys, Tesla can do that. And that's another reason why I wanted to buy puts. Options love volatility. And even if you love Tesla, you know that it has the capabilities to make these huge swings up and down. And the way I see it, as long as we don't get too many ups, all I need is really a week where it just crashes and burns for just a week, just enough to make my contracts more profitable, and then I can sell to close them. Like I said, I don't need it to get to 150 for me to win, but I was watching this day just to make sure that it did not just completely bounce off, and it really did. And this line in yellow, guys, because even though this is a LEAPS, I still have a stop loss, and my stop loss was right at the top of these wicks right here at 189.04, and frankly, it is still there at 189.04, and we got close. We got close. Finger was on the trigger. It did not make it, and then I was very, very happy to see, because I thought we were going to wake up and it was going to go through my stop, and that was going to be that. Woke up, had this huge gap down, came flushed down pretty nicely, and I was like, oh my God, this is gonna, I felt like the smartest man alive, but no, this is reality, and it bounced back, but once again, back into the zone, but now it's not coming through the zone. We really can't see. We got it rejected out, came back in, tried to reject out, and this was right at the close today. Today is the 6th, Tuesday. Right at the close, I took this screenshot, so we'll see what happens in the overnight. Like I said, this 189 will still be my stop. If you're watching this way down the road and it's trading for 190, know that I am no longer in this trade, but we're going to watch this continue, and I'm probably going to look for about 50%. That would be my cutoff. 30 to 50%, I'll really consider whenever that happens on closing the contracts. But I watched this day because I wanted to write contracts against the puts that I bought. So let's talk about that, because it's a little different than a cash secure put, and it's actually a more affordable way, just like the poor man's covered call that you've seen me. I think my most viewed video, 750,000 views, is on the poor man's covered call, doing this to the upside where you buy a LEAPS long call and then you write calls using that as collateral. You can do the same on the downside. You can buy puts and then write puts against it. Let's talk about those contracts and exactly how I'm going to be working those and my strategies and like my break evens and things like that, in case you want to give a spread a try. Once again, guys, this was right at market close. A couple of details here. I did this on Robinhood. You can see the date I bought this is 2/2 plus 1. The plus sign means I bought, and we can see up here a put 150. The break even price, that would be if I wanted to exercise the option, meaning if I was going to exercise this option because I had to pay money to get it, I need to make sure that the price was below that to make sure that I'd be profitable while I'm going to exercise. The fact that I'm not going to exercise this option at any point in time, that doesn't really matter to me, but how they come up with this, 150, okay, minus the $14.15 I paid, that gives me the $135.85. And once again, if you're new to options, that $14.15 is a contract is 100 shares. So that means I paid $1,415 for this LEAPS that's expiring January 17th, 2025. So pretty much 1 year out. The current value of that was $14.50. So we can see my total return right now after about a week, 2.47. I've made $35. Today actually wasn't a good day, and it kind of chopped around. And there's really no theta for a LEAPS right now, so I don't really need to worry about that. But I did have a $78 loss on the day, but overall, this is profitable, $35. But the main thing while we sit and wait for this to do what we want it to do is now with a cash secure put, right? Let's go back to a cash secure put, the wheel strategy I love so much. When you have a cash secure put, you need the cash to secure that put. The cash is the collateral. So if I was going to do a cash secure put on Tesla at $150, that would mean I would need $15,000 for me to write a put. Now the put that I wrote was not for $150, it was for $165 put. That would mean that if I want to write a cash secure put without this, I would need $16,500 to write that put. But for $1,415, I'm able to do the exact same thing and create the exact same premium income by doing this strategy and by creating a spread. So now that I have this open, and you can do this spread all at once, you can buy and sell all at once. I tend to do them separately because I want to buy this option on a green day, right? Because premiums are going to go down and I want to pay less. So I wait for it to be a little bit green and I buy that, and then I wait for it to be red so I can sell the option. That didn't really happen here because it was kind of chopping around. I just kind of wanted to get it done, get it inside the Discord so people could see. But here is the put that I wrote against this particular contract. In my last video, I talked about my expiration dates and how I choose those. You can check that video out. I'll link it down in the comments or something. These are going to be 30-day expiration puts. So here it is. The 165 put has an expiration date of 3/8 this year. All right. I got $250 for writing this put. The break even, once again, not too worried about it. The -1 tells me that it is a sold contract. I sold it on 2/2. Right now, this is profitable, $4. This would be the exact same as any other wheel. If I get to 40% profit on this guy, usually actually with the wheel, I'd probably wait till 7 before I close it. But if I get to 40-50% on this, I am going to close this this option and then write another put. That's pretty much going to be the goal. But guys, if you are going to do this strategy, okay, and I reiterate this in the other video about the poor man's covered call, under no circumstances can you let this get assigned early. If you do, it blows up everything that you are trying to accomplish. These sold puts for me are either buy to close or roll. There is no way I'm letting this go to expiration, which makes it a lot more confusing if you are going to do a stock that has dividends, because sometimes people will exercise to capture that dividend. With this, I should be pretty good to go, especially with only 30 days out, unless this thing really gets deep in the money. Oh, hey, hi, it's Brad here from the future. I know my Discord there, sharp as a whip, and they're going to ask me this question, and I forgot to add it, so I'll add it here. With the cash secure put, I choose my strike price according to fair market value. Well, here, I really don't have a fair market value, really, so how am I choosing my puts, my strike prices for my call puts? What I'm doing is I am going back to the Greeks. I'm using delta, being super conservative. So all my puts, 30 days out in expiration, 0.2 delta. That's really how I'm choosing the strike prices on my -1 puts. All right, back to the video. So let's put a graphic up here of exactly what just happened and how I put this whole spread together. I did first a +1 put. So I bought a put at a strike of $150. That cost me $1,415 to do. I then used that contract as collateral to write a put against it at a strike of $165, which got me $249. Essentially, because I have this for 12 months, As long as I can write puts for $118 every single month, when I get to the end of the year, I will have received all of the premium that I paid for that contract. It would be a break-even scenario for me. And if I can get $250 a month, that means I'm going to make $3,000 in just the cash secure puts, just the puts I write. Now, I'm not going to get full premium because I am going to buy to close them early. I am going to roll them. But if I can get $118 a month, I can pay back the option that I bought, the put that I bought. So far right now with the $249 that I've collected, I've taken that $1,415 all the way down to $1,166. That's kind of how this works. We're using the puts we sell to essentially pay ourselves back for the put we bought. And the bought put is going to change price and become a lot more profitable than a call, than the put. Because we know when we sell a put, it has a fixed income. You could only collect the premium. But when you buy a put, you can have a much larger return. Some other things to note. Because I wrote the put higher than my strike, $15 difference, I need to pay that collateral. I needed to pay a collateral of that difference. And here's exactly what's going to happen if, by some chance, the put that I wrote was assigned early. And this is really going to depend on the broker, but it's going to be about a similar process. Sometimes they will give you the option to buy shares to cover the put that was assigned. But in my case, in the brokerage that I use, if my -1 put is assigned, my broker is automatically going to exercise my +1 put. They are going to exercise it automatically because when I do so, I'll receive 100 shares to essentially give to the sold contract that I had. I'll lose the collateral if my sold put has a larger strike price than the 150. Once I get below the 150, I won't lose any of that collateral, but as long as I'm above that, I will lose that, which is, like I said, under no circumstances do I want this to happen, but if it does, right, let's say the put that I wrote gets assigned, they're going to automatically exercise to get the 100 shares to then give to this person, and that's going to be the wash on that. But that would be awful because, like I said, I would lose the collateral on the strike price, and it would also happen because the +1 put is probably going to be worth a lot more than if I exercise it, right? When we sell to close, we get more money than when we exercise. Because when we exercise, we just get the shares and the intrinsic value. That's why, oh gosh, I made videos, you never exercise options early. But that's really the main risk here. I have to make sure that A, my put that I sold does not get assigned, and that I don't go too high above my strike. Because like I said, if above my stop, if I get to my stop and I got to sell this for $500, I'm going to lose $500. But if I don't assign a stop loss on the leaps and it goes up and up and up, I'll lose the whole thing. Eventually it'll expire worthless and I'll lose my entire $1,400. If you have any questions, guys, leave them down in the comments below. If you want to give me your opinion on Tesla, give a 1-year prediction. Am I going to be right? Am I going to be wrong? I mean, if the video is going to be here in a year, we'll find out then. I hope this was helpful. I hope it at least got you thinking about the cash secured put being a poor man's cash secured put instead of a poor man's covered call. If you want to hop in the Discord and see all these trades as they happen, that link is the first link down in the description below, guys. And I'll catch you on the next video.